How you doing, everybody? It's Hollis Full of Love, CEO and founder of Crane Financial. I'm here again with my main man, Richard Wimberly, retail investor. How you doing today, Rich?
I'm doing good, bro. How you doing?
Doing good. I can't complain. Can't complain. So, piggybacking off our last video we did, we previewed a bit of what options view looks like in Active Trader Pro. I know you said people have reached out to you and want to know a little bit more about options trading. So I think it'd be really good if we can get a bit of a background in it. So just for the most simplistic view of it, what is the difference in purchasing a stock and then trading options?
Yeah, I would say the biggest difference is that buying a stock is you purchasing a small piece of ownership within the company that's listed under the stock. Right. While an option is you basically signing a contract that gives you the right to buy or sell that stock at a specific price or a specific date.
Right. So are you saying then I can look at a stock, for example, Apple, which I have put up here, I'll show people in a minute, is at $307.71 at close on May 15th, which was Friday. So I can say, in theory, hey, by May 22nd, I want to have the option to purchase shares of Apple if it's at the price of, let's say, $299, or if it's at the price of $310.
Yep. So what you described in there is the two different nuances of types of options. So you can buy a call or you can buy a put. If you buy a call, you're anticipating that the stock price will increase. If you buy a put, then you're anticipating that the stock price will decrease. So in the example, if you wanted to buy a call, that means that you think the stock is going to go up again. So we would say, all right, Hollis, I want to buy Apple at the current price, but I think that it will rise to $310 by Friday, which is May 26th. And then you on the other end of that transaction says, okay, I will give you that option. And then you give me 100 shares for every contract that I buy. And we can go into that more as we look at the table to try to explain what all of this means.
So let's break it down. I'm going to share my screen here. So like I said, we have Apple and the price is $307.71. Now what we're going to do is go into Active Trader Pro, right? So Rich, could you give people just a quick rundown of what's going on in Active Trader Pro here? Obviously, everybody doesn't have to trade in Active Trader Pro, but we want to encourage people to do so just so they can get more of the technical aspects of it all.
Yeah, absolutely. It's a one-stop shop, right? Like, so if you can try to just use one application or one platform where all of your stuff is at your disposal, it makes the trading a lot faster and it makes the user experience just better. So here what we have on the screen, on the top left, where you have your symbol and your total account value, that's going to be your summary. So if you were actively in a trade, you will see the value of that trade in the lines that are below where you see SPAXX. So if we had an Apple contract, we would know, all right, we're up $50 on this contract, we're up $100 on this contract, or if we were losing money. On the bottom left, that's your options table. So this is where we're going to go to determine what the bid and the ask price is on the contracts that we want to buy. So again, using the same example, if we want calls, meaning that we think the stock is going to go up, we would say, all right, I wanted to buy this at $310. That $310, that is your strike. So you say at $310, and then you slide to the left where you see your bid, I'm willing to pay between $390 and $410 times 100, which will be $390 or $410 to purchase the right to buy the stock.
Okay. Now question. Let's say I purchased the right to buy that stock anywhere between that $390 and $410, right? What happens on May 22nd when it does or does not hit that $310 price point?
So there's a couple things. So before you get to May 22nd, you have 5 days to try to get closer to that price. And this is like the word option, like really kind of describes exactly what you have as a trader. So let's say on Monday, the market opens and Apple is at $309. No, you haven't reached your $310 price, but your contract value is going to increase because other people are now willing to buy that same right that you have at a higher price. So you can either sell your right to those people, or you can continue to hold it. And then you hold it until you get to your May 22nd date. Now, then what you can do is you can exercise your option, which means
stock.
Right. Then you purchase 100 shares for every contract that you own. Or if you never reached your $300 or $310 price and your contract value starts to dissipate, you can choose to just let it expire out of the money, meaning that you didn't hit your strike price, and then it's just gone. So you lose your investment.
You just lose. Okay, so it's three different results, right? I can say I'm purchasing the calls for May 22nd expiration, right, between $390 and $410. That price goes up, more people are interested in buying it, I could sell for a profit, right? So I could sell my options at a profit if the price does go up, one, or if two, people are more interested in buying at a certain price. My second option would be I could let it expire all the way. And at that point, my $390 to $410, whatever that was, is just gone, it's lost, right? Yep. Or I could try to sell it at a loss. So I'm not going to hit that $310 price point, right? I'll be in a situation where I might not be able to recoup my full $390 or $410. I might just be able to recoup $200 or $100, but at least I got something from it. Or, and the last one would be I could exercise that option, and now I have the option to purchase 100 shares per contract that I bought.
At the price that you signed up for.
Right. Okay.
Most people, the big one that they want to do is the first one, where we're going to buy the right to buy the stock, but we never actually intend on buying the stock.
Right.
We're going to sell it to somebody else and just take the profit that we get from the contract price increasing over that time.
100%. That is the name of the game to make money, whether you're buying calls or puts. So let me ask you something, Rich. Now this will be based on your research, whether you say, hey, I want to buy calls, or hey, I want to buy puts, correct?
Yep.
Okay.
So the first thing you want to do is your underlying asset is the stock. You want to evaluate, is the stock undervalued or overvalued? If you think the stock is overvalued, then you would anticipate that the stock price would drop. And there's a ton of different ways to do that, right? So there's obviously speculation, so news. So if you find out that some plant in China is going to be shut down and Apple is going to have a 20% decrease in the number of iPhones that they can manufacture, that would be something that you would think, all right, the stock price is probably going to drop as this news starts to come to fruition. Right. Or it could be just something as simple as a lot of people have been buying the stock over the last 2 months because people are looking for a safe haven stock where they're not exposed to coronavirus fluctuations. Right. And then you think, all right, now it's overhyped. Too many people have done it, and then they're going to take their profits. And when they take their profits, that's going to make the stock drop.
Right.
So those are the two kind of decision tree things that you can make on if you think the stock is going to drop. If you think the stock is going to increase, it works the opposite way. The first one is some kind of speculative news that says something good is going to happen with Apple. It could be all the Apple stores are opening back up next week.
A new iPhone's coming out.
A new iPhone is coming out. Or it could be simple as the stock has dropped 20% over the last 2 months. It's starting to be oversold. And that means that it's still an attractive buying price for investors. And if investors are willing to buy the stock at that price, then the demand increases. As the demand increases, the stock price rises.
Yep. Simple economics. Okay. So you want to maybe walk through trying to execute options trade?
Yeah.
Okay.
And I will preface this with saying options trading is a lot more complicated than investing in stock. And you have to think a little bit differently than you would when in just a long-term stock. So
different philosophy.
Yeah. One of those things where you should definitely understand how the market works first before you jump into, I want to trade options. This is like the advanced version of the stock market game.
Yeah, for sure. It's definitely more so of a gamble than just doing a traditional value investing.
Right. And then with that, obviously, with greater risk, there's greater ROI. So that's the cost benefit analysis you got to weigh on if options trading is for you and Like you got to be willing to kind of have some emotional discipline and also like come to grips with an amount of money that you're comfortable putting at risk.
Because, for example, if you was to purchase a share of Apple stock at $307, whether the price rises or drop, you won't be at zero because Apple's not going to hit zero. You know what I mean?
That's the huge difference. Apple's not going to be at zero, but you're not going to make 100% off of your investment in the week. Versus contract, that 390 contract can easily go to 780 in a couple of days, depending on how the stock moved over that period that you had your contracts.
Yep, most definitely. So let's go into ActiveTrader Pro and try to do a trade here. Obviously, the market's not open. We don't have a lot of money in the account. We just kind of want to give people an idea how it will work.
Yeah, for sure. So we've kind of already explained like the top left portion. I think it's important to go through on the top right that chart. So that's your 1 year on Apple. And if you're an options trader, chart reading is of absolute importance. It's like if you're not going to read the chart, that's like not looking at the balance sheet before you buy a stock.
Right.
Or loaning somebody money and you didn't pull their credit report. Like that's kind of the way to look at it.
Yeah.
All right. So we look at the chart and then we also look at the trading volume, which is underneath it.
Okay.
All right. So we see over time, there was a steady incline in Apple share price. And then around March, we've seen a huge dip.
Yep.
So for us, we say, that looks like an opportunity to buy, right? Because it was oversold at high volume, which means that there's a lot of demand in this, which gives you good volatility and good price fluctuation. So we would try to time it to say, all right, as we get to that last red bar, we want to open a position in an option for Apple. So let's say that this is March 3rd, not today.
Okay.
Then what we would do is we would go to the options table on the bottom left.
Okay.
And then we would say, all right, I don't want to pay a premium for all of the extra time that makes my investment safer. Because for every 7 days, that gives you a longer expiration window for what you think is going to happen. But in order for you to get that, you got to pay for that security.
We see that here, right? So, for example, if we was to do May 22nd, the price is $281, right? But if we do May 29th, another week is $465. So,
right. So for 310 is 390 to 590. You paying an extra $200 for a week of security, right? So you got to weigh how quickly do you think the thing that you think is going to happen will happen.
Yeah.
If you think it's going to happen in the same week, then cool. Then you don't need that extra security with the additional time window. So we go for the 310 strike, and then we say, all right, we want it at 390. So then if you hover over to 390, Hollis.
Right here.
Yep, just click that. Boom. So you click that, and then down at the bottom, you want to exit out of that first one there. Yep, there we go. Yep. So now this is super important because you can buy options and you can write options. We're only talking about buying options. So what you'll want to do is where it says sell to open, change that to buy to open.
Buy to open. Okay.
So think of it like you are buying to open a position.
Yes.
All right. So the number that you see there, that's the number of contracts that you'll purchase. So remember, if you select one, you got to multiply the contract price by 100 to know how much you're spending. So
it would be $390 in this scenario.
Yep. And then we already have our expiration date, which is the March 22nd.
May 22nd.
Price, which is the 310. And we think the stock is going to go up, so it's a call. If we thought it was going to go down, it would be a put. And then where it says order type, you would choose if, let's say, just to keep it simple, the market's open and you're comfortable like with your trade executing anywhere from the 390 to 410 window, you just do a market order.
Right. And I'll get anywhere, like you said, between 390 and 410 at that point.
Yep. And then from there, you just hit preview, and you submit the trade.
Okay. Well, obviously it's not going to submit because it's not an active trade that we can actually do right now, but that's
exactly.
How it
Yep. And then let's say it's Wednesday or Thursday and the stock has gone up $5. It's way over the 310.
Right.
Now everybody wants the right to buy it at 310 because it's at 312.
Right.
So now your contract price is $10. So you made $600 off of each contract. And you're like, ooh, I'm ready to get out because I don't really want the shares. I just wanted the money that would come with selling the right to somebody else.
Exactly.
But then what you do is you would hit sell to close.
Sell to close. Okay.
So now.
So you're selling to close your position.
Exactly. So you sell them to close it, and then you preview the order, and then from there you can do your market order again, and it's going to instantly submit your trade. And as long as you have good volume and open interest at the strike, which for Apple we see there are 4,057 at our strike, so that means we're good. We only got one contract, so there's somebody on the other end of that transaction that's willing to buy it from you.
Wait, but hold on now. Explain this. This 4,057 means there's 4,057 other people willing to purchase at this price?
There are 4,057 other trades.
Okay. Okay. See,
so that's your open interest, meaning that there are 4,057 other trades that are just like your trade.
Okay.
And you always want to see a good open interest, and if the market is open, a good volume number. The volume number is the trades that happen that day. Open interest is the trades that are active in real time, like right now.
So, for example, at this 297 strike price, it's only at 564. So, do you then run the risk of not being able to execute your trade because there's not as many people interested in it or have the same trade going on?
In the trade, and if you look at the spread between the bid and the ask, it's a 55-cent difference versus at our 310, it's a 20-cent difference. And that is because there's just simply not enough buyers and sellers at that strike price.
Okay. Cool. All right. I think you've made a lot of sense there, sir. Is there anything else, again, as a first-time investor, somebody is looking to get into options? Obviously, like you said, you want to be a little bit more of an experienced investor doing this to begin with because of the risk involved. But from a first options look standpoint, is there anything else in Active Trader Pro we need to cover, or anything else that you think someone will need to understand?
Yeah, we've got two other windows that we can kind of explain the way to leverage those.
Okay.
So the one in the middle where it has like a little chart. So this is going to be your trade armor. So it's going to give you the 40-day moving average, which is really important for options trading because it's going to tell you where your support and your resistance lines are.
Okay.
So remember earlier we were saying, oh, if Apple was overbought at blah, blah, blah time, then that would mean that we should buy the option.
Yeah.
So that blue line at the bottom.
This one here.
Yeah, that's going to be your support line. So that means when the stock drops below that price, it's going to bounce right back up from that.
Okay.
And then the green line is your resistance. So that's when if the stock is above this point, there's a great chance that the stock will drop.
Okay.
And that orange line, that's just your 52-week high. That's the highest that the stock has ever been over the last year. So those are key indicators that you'll need, that you want to try to bake into your logic before you execute a trade.
Okay. And then, so what's the next window?
Yeah. And then over on before you go to the next one, there's a couple of like research tools you can use here. Mm-hmm. One is expected report is. With options trading, earnings are paramount. Like they're super important. And then it's going to tell you the dividend date. The reason why those two things are important is after earnings reports, there's usually some volatility in the price. That's a good time for you to try to make money on your contract. And then for dividends, you could either see a stampede of people trying to buy it because they want to get paid out that dividend, or people who have got the dividend paid out and they're like, well, now that I got my dividend, I'm about to sell the stock. So those are two like price fluctuation points that are really relevant if you want to trade options.
Okay. All right. So this last window.
Yeah. And the last one is just going to give you like some data points that you can use when determining what you think is going to happen like with the option. So first thing is giving you total volume, and it's going to give you a spread of how many calls versus how many puts. So as you can see, it looks like it's 1.25 to 1. So the stock is more bullish than bearish, meaning that there are more people that think it will go up than go down, right? Okay. Then there's also like your open interest, which we kind of covered earlier. And then if you go to today's biggest trades, it's going to tell you what have the major players done? So the people who are buying significant positions, like what decisions are they making? And the reason why this is important is because they have enough money to move the market.
Right.
So you see a lot of money moving towards a certain way, then it's very likely that they're willing to exercise their option and they're going to buy the stock. They buy the stock may go up. Or if they get puts, then they're buying the right to sell the stock at a different price. Then they're going to sell the stock. And because they're selling so many, the price will drop.
Right. It devalues the company. Okay. All right. That makes a lot of sense, man. I appreciate you for explaining this and making it so simple.
Yeah, man. And there's one more tab, just real quick. Go to probability calculator.
Okay.
All right. There we go. Perfect. So I think a lot of people are visual learners, so I wanted them to be able to see this. At the target price of 307, which is what the current stock is at, you'll see like the probability of that stock reaching that price by the time that you said. And on the table below, you can kind of see like what are the chances of that happening. So right now, if you look over time, the market expects this stock to drop. Which is why you're starting to see like the below 307 percentage increase week to week.
Okay. All right, perfect. And this could be over a number of factors. Right now, we might assume it could be something coronavirus related, or because people, whatever it may be in the marketplace, that's going to be the reason that's going to give you the probability of either going up or down.
Yeah, it could be coronavirus related, or simply be that that analysts think that the stock is now overbought.
Right.
It could be simple.
Yeah. Sure. Okay. Anything else in the Active Trader Pro that we need to review?
No, I think that's it. The other two tabs are more for people that are exercising the option, and I don't think that anybody that will be watching this video will be in that position. So I would ignore it.
Okay, so I'm gonna close out, man. Really, just want to thank you again, man. We really appreciate all the insight, knowledge that you're giving to people, man. I really think you're helping a lot of people with this, Richard.
Yeah, man. It's just another way to try to generate some income. Obviously, there's some risk involved in it, but if you put the time in, it's definitely something that can become like a vehicle for you to make your money, make some money.
100%, 100%. Well, we will be back again soon. Like I said, thank you again for your time, and stay informed, stay aware, keep on hustling.
Same to you, bro.
All right, man.